So guys, welcome to chapter 9. Now, I am working out of the Spiceland 5th edition book. I'm teaching a class here in Minnesota, but for those of you who are getting this online, welcome also. Please subscribe to this channel, and anytime that I post something new, you'll get it. But I am specifically here for these 6 precious souls that are learning about long-term liabilities today. So we're going to start this, guys. It can be a tough chapter, but I am really going to try to, I hate to say the word dumb it down, but come on, however we want to say it, simplify it. Simplify it so it doesn't have to be so overwhelming. So while we're in this chapter, guys, you need, if you have questions, you need to pause, unmute your microphone and say, Nancy, stop. I'm really stuck. I am telling you that is what I want you to do. Okay. That doesn't offend me or it doesn't annoy me. It's that if you have a question, chances are other people out there listening to this video down the road are going to have a question too. So I'm inviting you to please ask questions. You know that saying, no question is too dumb except the one you don't ask her. Something to that nature, you get it. So we're starting. We're talking this week about long-term liabilities. Now, the biggest type of long-term liabilities are bonds. And we're going to talk about bonds and how they work, okay? So long-term debt is generally going to be utilized for major capital improvements. Right now at the school that I work at, they are totally renovating the business building. That's through bonds, long-term bonds. Our bonds are pretty much all long-term. But there are ways companies can finance big projects. One way is through a mix of liabilities and stockholders' equity. Now, stockholders' equity means shareholders purchase a piece of the company. That's equity. That is not debt. It increases the ownership, or that's part of the ownership of a company. So a mixture of stockholders and debt is how many people may choose to finance companies. Debt is borrowing money. Equity is getting more money from stockholders. Companies get external funds through what we call debt financing, borrowing money, and through equity financing, which is stockholders. One advantage of debt financing is that interest on borrowed funds is tax deductible. Now, guys, I will say to you, there is a whole, like in higher accounting classes, there is a whole, tons of information and learning to do with debt and equity financing. Now, I will tell you, generally speaking, equity financing can be more expensive because since shareholders own a piece of the company, they want a piece of the profits. Where when you have debt financing, it's basically paying interest and then paying back the debt. So they never are a piece of the company. It's just pure interest. Now, in times of inflation or in times when there's a tough economy, debt financing can be riskier. But that's a whole nother subject in another class. So guys, we're going to start with our first multiple choice. Which of the following statements is true? Profits generated by a company or a source of external financing, dividends paid or a tax-deductible expense, interest paid on debt is tax-deductible, or all of the above are true. Now, I'll tell you what number A is wrong. Profits generated from a company are internal sources. They are not external sources of financing. Dividends are absolutely not tax deductible. So the only answer here is C. Interest that is paid on debt is a deductible expense under interest expense. So oftentimes there is, whenever you have debt, there is usually you pay that debt each month. So car loans and home loans call for monthly payments, which we call installment payments, rather than just a single amount at maturity. And when those installment payments are made, a portion of that payment will be treated as interest, and a portion of that payment will be treated as a reduction in principal or a reduction in the loan balance. So here we're looking at an example where there's a $25,000 6% 4-year loan for a delivery truck on January 1st, 2018. Payments of $587.13 are required at the end of each month for 48 months. So we're starting out by borrowing $25,000, and we know each time we're going to pay $587.13. The way we calculate the interest is by taking the carrying value of the loan. In this first portion, the balance is $25,000 times 6% is the annual interest rate times 1/12, because we're paying this down every month. So the interest on $25,000 we calculate by 25,000 times 6% times 1/12 is $125. That $125 is going to be subtracted from our monthly note. And the difference is what we're paying against the principal, or what we call the carrying value, the amount of the current loan amount. So the 587 is the amount we're paying each month. The interest is 125 for the first month, which means the difference, the 587.13 minus the 125, gives us the amount we are paying off on the loan, or 462.13. The difference between what our loan balance was minus what we're paying off against the loan balance is now $24,537.87. So now in the second month, when we calculate the interest, we're going to calculate it based on $24,537.87 times 6% annually times 1/12. Do you see in February that the new interest expense for this month is $122.69? So we still make our payments of $587.13, and we subtract the interest to come up with how much reduces the balance of our loan. And you see in the second month, the amount that we put towards the loan amount is $464.44. So then we'll reduce our carrying value by that amount. So then in the third payment, we're only paying interest on the new carrying value. This continues to occur for 48 months. And you see the last payment, we had a carrying value of $584.21 going into that last payment. The interest of 6% times 1/12 on that carrying value is $2.92. And in that last payment, you see the carrying value is now 0. This, guys, is an amortization schedule to show the process of paying down the note. And it continues, the note or the carrying value continues to decrease. The cash paid stays the same. The interest expense decreases. And the amount we're applying against the carrying value will continually increase. So, how would we record these transactions? So, in the first payment, we would show that we received cash, or excuse me, not the first payment, taking up a note. We would show a debit to cash of $25,000 and a credit to notes payable for $25,000. Then the first payment would be a credit to cash of $587.13. And that's going to be broken up by the interest expense of $125 and reducing the note payable of $462.13. The second month, the cash amount that we pay will always be the same, but the interest expense and the notes payable will continue to change each month. With the interest expense decreasing, the interest amount will decrease each month, and the notes payable, what we're paying off, will increase each month. Okay. Okay. Sorry about that. So this shows you the journal entries for those first two payments. Remember, guys, most notes payable require periodic installment payments. Each installment payment includes an amount that represents interest expense and an amount that represents a reduction of the outstanding loan balance, paying down the loan balance. So guys, let's take a moment. Guys, really try this. Just don't look at what someone else is putting in the chat box and then key it. Try this, guys. Tropical Paradise borrows $24,000 and agrees to a 5% 5-year installment loan with the bank. Payments of $452.91 are due at the end of each month. How much interest should be recorded for the first month? Take a moment and attempt it, guys. Remember, it's not for a full year. It's for 1 month out of 12 months. And Allie, just because I've spent time talking to you, can I be so presumptuous as to ask you to explain it? And if you want to pass, you can say, Nancy, I pass. And I am totally cool with that.
Yeah, sure. So
Okay. Take your time though, honey. You don't have to jump on it, but whenever you're ready, you have the stage.
okay. First I just want to make sure that I'm right. And is it B?
I haven't even looked yet. Hey, how about this? Yes, sweetie. Okay, tell us how.
All right. So what I did is I took the 24,000 and then I multiplied it by 5% and just moved the decimal point over 2.
Mhm.
And then I multiplied that by 1 divided by 12 because it's 1 month out of the year of 12
Yes,
months.
exactly right, Allie, exactly right. And because I feel like we've connected before, I'm going to kind of pick on you a little, and you can please don't ever feel like I'm picking on you only because I feel like I kind of know you a little. So, and anybody, if I ever ask questions and it's uncomfortable, this forum, this place is never to feel threatened or uncomfortable. It's about learning, guys. So if I ever ask you, hey, help out, you just say pass, Nancy, and I'm so cool with that. Okay, guys, I just know people are tired of hearing my voice. Allie's is a little prettier voice. Does everyone get how Allie came up with B? You're right on. Okay, guys, we are going to spend some time looking at this problem, and you're going to have this for homework. This is in the back of the book, and this is a homework problem. On January 1st, 2018, Stoops Entertainment purchases a building for $610,000. They pay $110,000 down, and they borrow the remaining $500,000, signing a 9% 15-year mortgage. Installment payments of $5,071.33 are due at the end of each month, with the first payment due on January 31st, 2018. So the first thing we're going to do is record the purchase of the building. Then we're going to create an amortization schedule and just finish the first 3 rows. Then we're going to figure out what the first monthly mortgage payment is and how much we're going to apply to interest and carrying value. And then we'll handle the last question. So guys, it's really pretty methodical here. The first thing we're going to do is show we purchased a building, and we're going to show how much of a loan we took out and how much cash we paid. So we are going to show a building is an asset, which means we debit it. So the building is acquired for $610,000. The cash portion we paid out is $110,000, and the note payable is $500,000. So this is recording the purchase of the building. And I'll just give you a couple minutes to kind of write this down or process it. I'll be back in 30 seconds. Okay, guys? Now, the first three rows of an amortization schedule, you always start with when the loan was taken out. So you see there, January 1st of 2018, over here you see a carrying value of 500,000. Okay, that's the first row of an amortization schedule. Now, the second row is going to be the first payment. We know the payment is $5,071.33. So we show in that section the cash that was paid. And the way we figure out the interest expense is by taking the carrying value times the interest rate times 1/12, which is 3,750. The difference between what the cash is minus the interest is the decrease in carrying value. So then that carrying value decreases at the end of month one to now $498,678.67. So then when we go to the second payment of $5,071.33, we take the $498,678.67 times 9% times 1/12, and the interest is $3,740.09. The difference between what we paid in cash and that interest goes against the carrying value of the balance on the loan. Make sense? So then we come up with a new carrying value. Now it says, record the first monthly payment. So we always are going to credit our cash for $5,071.33. We debit the interest expense, and then the difference is the reduction in the note payable. Now it asked us, over 15 years, how much interest will we be paying? Well, guys, it's actually it seems confusing, but it's really simple. If we're going to be paying $5,071.33 for 180 payments, then we take away the loan balance, and we know the rest goes right into interest. Okay? So know that that is how
Okay.
yes,
Can you say that again on the last slide?
of course. If you think of, we have a 15-year mortgage, and if we're going to pay $5,071.33 every month for 15 years, how much are we paying out? We're paying out $5,071.33 times 12 months times 15 years, aren't we? Now, here's the deal, guys. If our loan balance is $500,000, isn't the rest going to interest? So if we are making a total payment of $912,839, and if we know our loan balance is only $500,000, doesn't the rest of the payments go straight to interest? because our payments are either going to be interest or principal, right? And if our principal is 500,000, then we know the rest has to go to interest. So in financing, oftentimes people finance assets by lease agreements. One sec. By lease agreements. And there are two types of lease agreements. Now, we're familiar with what we call an operating lease because sometimes we see people have this in automobiles. Instead of actually owning the automobile, they lease it for a period of time. And so the lease is just basically using an automobile like we do with apartments. We just pay a certain amount and we lease the apartment. And that lease is saying, hey, I get to use this. I don't own it, but I get to use it for a period of time. And then at the end of the lease, we walk away from the apartment or the car, and we are done. That's the operating lease we're familiar with. There's another type of lease that companies use, is called a capital lease. That's where the lessee actually buys an asset, but it borrows the money through a lease to pay for the asset. Now, it's different from an operating lease because with an operating lease, we know we're going to return it. We don't want the asset. We borrow it, we return it. But with a capital lease, we're really owning the asset. And we're using the lease technique as a manner in which to finance it. Why do companies do this? Well, leasing can improve cash flows. In a purchase, most lenders require a down payment up to 20% of the asset. Leasing can allow you to finance the entire purchase. This is the crazy thing, guys, we're going to learn about. Leasing improves the balance sheet by reducing long-term debt. So if you think about it, when you purchase an asset and you take out a corresponding mortgage, we have greater long-term debt. Now, if you lease something, you're not going to show that long-term debt. Therefore, when you compare one company's ratios to another company's ratios, you're going to look better on the balance sheet, even though there might be so similar with companies. The ratios will look better just because of the way they structured certain financing methods. And then leasing, because the lease payment is deductible, it lowers your income taxes, lowers your net income. When you borrow money and you pay down the loan, you can write off that interest, but the reduction in the carrying value is not deductible. That's just a reduction in the debt. So when you're dealing with leases, it gets to be an expense. Here's an example. If one person, let's just assume company has an assets of 100 million, liabilities of 60 million, and stockholders' equity of 40 million. And then the company signs a lease to purchase a long-term asset valued at 10 million. So if we treat it as a capital lease, not an operating lease, the because it's technically purchasing an asset using the structuring of as a lease. The assets increase, but the liabilities are also going to increase because this is called a capital lease. You're really buying it under the guise of a lease. But look what happens to your ratio of liabilities to stockholders' equity. It's more unfavorable because we do get to increase our asset, but we're increasing our liabilities by the exact same amount, which ultimately shows a greater ratio of liabilities to stockholders' equity than it does if a company just does an operating lease. When you're comparing two companies, one structures it one way, one structures it another, you see how it can be unfavorable. Under the capital lease, the ratio of liabilities to stockholders' equity is definitely higher. No, guys, an operating lease is recorded just like a rental. But when you're dealing with a capital lease, the leasee is really buying the asset and borrowing the entire amount. So we show the asset increase, but we also have to show that liability of the same amount as the asset. So guys, how about this one? Which of the following leases is essentially the purchase of an asset with debt financing? A capital lease, an operating lease. C, both capital and operating, or D, neither. There's one right answer. Carter, what do you think? Anyone know?
Is it A, capital lease?
Carter, you rock. It is a capital lease. It's basically purchasing the asset with debt financing. Okay, guys. Coney Island enters into a lease agreement for a new ride valued at $2 million. Prior to this agreement, the company's total assets are $25 million and its total liabilities are $15 million. Calculate total stockholders' equity prior to the lease, not leased, agreement. Assuming an operating lease, calculate the debt to equity ratio. So if prior to this agreement, the assets are 25 million, the liabilities are 15 million. So we know that the stockholders' equity is going to be 10 million. So the debt to equity ratio, liabilities to stockholders' equity, is 1.5. But if they enter into a lease agreement where it's a capital lease, so we have to add the $2 million ride to assets, and then also it ends up being also to liabilities. So then under a capital lease, our liabilities are 17 million. Our stockholders' equity is 10 million. And do you see that our debt to equity ratio now is 1.7? Make sense? Give me one sec. Okay. Coney Island enters into a lease agreement for a new ride valued at $2 million. Prior to this agreement, the company's total Total assets are 25 million and its liabilities are 15. Why might Coney prefer an operating lease? Ultimately, it shows a lower debt to equity ratio. Okay. Now, what we need to do, and this is the hardest part of this chapter, guys, but I promise you, I'm going to make it easy. I'm really going to make it doable for you, okay? We're going to talk about bonds. Now, there's some goofy pieces with bonds, and you're going to ask me, why do they do it that way? And I'm going to be honest and just tell you, because it's just the way they do it. And that's not a good answer. Kind of like your mom says, because I told you so. That's kind of like they just do it that way, but it's goofy. But we're going to learn what you need to focus on. Bonds are debt instruments. They obligate the borrower to repay a certain amount at a specified maturity date. The difference here than an installment agreement is they pay the interest over the life of the bond. Okay, so interest on bonds typically gets paid twice a year, but the full amount of the bond usually gets paid at the end of the period. Generally, bonds can be secured or unsecured. Of course, secured bonds, meaning backed by collateral, are going to be less risky. They can mature on a single date or they can mature in installments, kind of like we talked about with that installment loans. They can be callable, which means paid off early, or convertible into bonds, from bonds to common stock. But no matter what, we're going to call them bonds. They can be secured or unsecured, term or serial, callable or convertible. Which of the following bonds always matures on a single date? It's a term bond, guys. Here's where it gets goofy. It's pricing a bond. We're going to talk about this. January 1st of 2018, California Coasters needs to raise money for a new roller coaster. They go and say to the public, hey, we want to sell some bonds, $100,000 bonds paying a stated interest rate of 7%. Meaning people will lend them money. They're going to get 7% interest rate throughout the life of the bond. And then when the bond is due in 10 years, they're going to get the whole amount back. Okay? How do we calculate the issue price? Well, basically, if the stated interest rate on the bond piece of paper shows 7%, and depending on what's going on in the market rate, on the market, is how we issue the bonds. Basically, what are investors willing to pay for bonds? Right now, we are slowly in the process of inflation, but we really haven't experienced our interest rates changing much. So the stated interest rate is basically just this number that's showing on the books or on the piece of paper of the bond. But that's not reality. What does the market bear? what really is going on in the economy. That's the key. No, the market rate is what's happening in the economy. Remember, the stated interest rate's just that number sitting on that piece of paper. Okay? But if they're the same, if the market rate happening in the economy is the same as the interest rate on showing on those bonds, the stated rate, then what's going to happen is buyers will be willing to pay the face amount for those bonds. So if it's $100,000 bonds and the interest rate on that piece of paper 7%, the interest rate in the economy is 7%, people are going to be willing to pay $100,000 for those bonds. It's a deal. Here's the deal though. If, I'm not going to do that yet. What if the stated rate on the piece of paper is 7%, but the market rate, what's happening in the economy is 8%, meaning the bond is a lower interest rate than what really can happen in the economy. Is a buyer going to get a cheaper interest rate than what they could get in the economy? No. But since we know that interest rate stated is on that piece of bond, the way to make it work is to buy that bond for less money than $100,000 to make up for that missing interest amount. So think of it this way, guys. If it says we're buying a $100,000 bond, but the stated rate on the bond says 7%. But if the market can bear 8%, we're not going to allow ourselves to have 7% interest. We want 8. How do we get that 8? We get that 8 by buying the bond for less than the face amount, or what we say we're going to buy the bond at a discount. So if we chose to buy this bond for $93,000 instead of $100,000, do you see that will make up that interest rate? So we would be willing to buy that bond for $93,205. Here's how we figure these things out then. We're going to use Excel and we're going to use tables. But what I'm trying to help you understand right now is the way these bonds are structured is goofy. The stated interest rate on the piece of paper is just a number. The market rate's what really matters. Okay? So if the market rate is higher than the stated rate, then bonds will be purchased lower than the face amount. The investor will pay less than the $100,000 because the bond is offering an interest rate 7% is less than what investors demand, 8%. If the bonds are offered at a premium, then what that means, if the market rate is 6%, which means what we're doing, what's really happening in the economy, but the stated rate says 7%, says higher, then we're going to spend more money on that bond than, because truthfully, the company who's issuing those bonds isn't going to pay us more than what the market is willing to bear. So while our payment will be greater, we will probably buy that bond for higher than the face amount. We'll buy it for $107,000 because the market rate is really what determines what things go for. So let me explain how we're going to do this. Okay. Go back here. let's do Excel first. Okay. There's a couple things you need to know. Number one, we need to know the face amount. Number two, we need to know the interest payment. How the interest payment is always calculated is we take the face amount times the stated interest rate, not the market, the stated interest rate that's on the bond. And usually bonds are paid twice a year. So this, in this case, would be half a year. But the market rate is what's really going on in the community, in society. And if the market rate is 7% annually, that means twice a year, it's really 3.5% every 6 months. So the periods to maturity will not necessarily be the years to maturity. It will be the number of payments to maturity. So in this scenario, if we have 100,000 face amount, we know the stated rate is 7%, the market rate is 7%. We key these things into a calculator and we will find out what the bonds will issue at. When, as I said, the stated rate is the same as the market rate, the bonds will also always issue at face value. But let's look at here. So I'm going to show you how this works. We're going to go to Excel. And we're going to go to formulas, financial, present value. This rate is the market rate. If the market rate is at 7%, that the bonds are paying twice a year, that means the market rate is 3.5%. The number of periods is how many periods of payments will you get. Let's say it's happening for 10 years, twice a year, 20 payments. What is the payment amount? If it's 100,000 and the payment is, the stated rate is at 7%, but we get paid twice a year. Let's say the payment's at 3,500. I feel like I did something wrong there. Let me do it again. Here, let me follow Scott so I don't screw up. So, where am I? Missing bonds. Let me do it this one, okay? We know the face amount is at 100,000. The interest payment is going to be 3,500. 100,000 times the face stated amount of 7% times half a year, 3,500. If the market rate is 8% annually, which twice a year, that would be divided by 2 or 4% every 6 months. And the periods to maturity are 20 because it's 10 years, but we get paid 2 times a year. That's where I'm going to go into Excel and show you how to do that, okay? So we're going to go here, financial, present value. The rate is 0.04, 20 periods, 3,500. The future value will be 100,000. I need to put a minus in front of that. No, I'm not doing it right, dear guys. What am I doing wrong? Oh, Lord. Okay, let me see. Guys, I'm sorry. Let me see what I'm doing wrong. Going to bonds is present value. I'm doing present value. I'm doing the face amount, market rate, interest rate, market rate, number of periods. Okay, so what am I doing wrong? Financial, present value, rate, 0.04, 20. I swear the future value should be 100,000. Okay, well, you know what we're going to do a minute, because I've got the wrong thinking going on. And so hopefully you guys get humbled or laughing at me, because what the heck am I doing wrong? Give me 1 second. Let me figure out what I'm doing wrong. Okay, guys, can we take 1 minute break? Are y'all okay? Let me see what I'm doing wrong. Lord, that was easy. Okay, I'm back. For some reason, I was screwing up. I used to think I had to put a negative somewhere, but I guess I didn't. I'm sorry, guys. So let's go back to here. So we've got the face amount, the interest payment, the market rate, and the number of periods. So what I was doing, I was putting in a negative because I used to think I had to do that. But in this case, if you go to financial, you go to present value, you put in the rate. This is the market rate, which is 4%. The number of periods is the number of payments. It's 10 years, but it's paid twice a year, so it's 20 periods. They're going to be paid $3,500 each period, and ultimately we're going to receive $100,000 at the end of the game. So how much would we be willing to pay today for that bond? Would be $93,204.84. So the way you handle this is you can use Excel to figure out how much you would issue those bonds for. You use the present value table in Excel. You go to financial, PV. The rate is the market rate. So let's just say the market rate is at 10% right now, annually, 5% twice a year. It's 10 years, but we get paid twice a year, so it's 20 periods. If the payment, the stated rate on the bond shows 8%, which means 4% every 6 months, and the bond is at 100,000. 100,000 times 4% is the payment amount of 4,000. And we'll end up with 100,000. Then we know if the market rate is 10, if the stated rate is 8, we would only buy that bond for 87,537 in order to get our 10% that we're going to want. That makes sense? So let's show another way we can figure this out. We can go to the tables in the book. In the book, they have present value of an annuity, and then they have present value of interest rates. Excuse me, present value of a single amount is the principal, and then the present value of an annuity, which is a series of payments. If you go to these tables and you find the interest rate and the number of periods, it will give you a factor that you use for that specific issue. So for example, let's see, present value of a single amount. Let me just go to present value of a single amount. So if we go to present value of a single amount, let's just pull this one up, for example. So if we know we have, this one doesn't go to 20, but let's just say it's a 7-year note payable twice a year. And the interest rate is the market rate is at 10% annually, but it's paid twice a year. So it's going to be 5% at 14 periods. We'll go right here to this number and we'll take the lump sum we'll receive in 7 years or 14 periods and multiply it times this amount to give us the present value of that lump sum. Then we'll use another amount, another table, the present value of an annuity. And we use this table in order to determine the payment amounts every 6 months. So if we have a payment amount of 10%, but twice a year is 5%, and we have 7 years or 14 periods, we will take those payments, and the payments are based on the face amount times the stated interest rate divided by 2, because it's twice a year. We take that payment, if let's say it's 8%, we take half of that, or the face amount 100,000 times 4%, and we will multiply that times the 9.8986 to get that present value of all those future payments. You take the present value of the face amount plus this figure, you get the present value of all those annuity payments to come up with what people would be willing to pay for that bond. We're going to go through a lot of problems here so you'll understand exactly how it works. Here's the key though, guys. No, key is the market rate. If the stated rate, just that number on the bond, is less than the market rate, then we will always offer bonds at a discount. No, interest rate we use to calculate the bond issue price will always be the market rate. Never, ever, ever the stated rate. People get confused and they use the stated rate. We only use that stated rate to calculate the present value, meaning, the stated rate to calculate the interest payment. So the stated rate is used to calculate the face amount on the bond times whatever that stated rate is. If we get paid once a year, we'd use that entire amount, the entire interest rate. If we get paid twice a year, we'll take that stated rate and divide it in half. The stated rate is only used to determine how much it's being paid every 6 months or every year. It's the market rate that we put on the Excel formula or what we use in our charts. Always. When the market rate is lower than the stated rate on the bond, we will issue bonds at a premium, which means we're going to pay more for those bonds than what the face value shows, because they're going to pay us more than what the market can bear. So we will always do an issue price greater than the face amount. We pay for it up front because we're getting more back throughout the period of time. So in order to figure this out, again, you would go into Excel. You would show how much payment you're going to get. The payment is determined by the face amount times the stated interest rate times, is it twice a year? Then you'll take that stated payment and bring it in half. You put the market rate, market interest rate, but if the annual rate is 6%, but we're getting paid twice a year, remember you have to take that market interest rate and split it. And the number of periods is how many payments, not how many years, how many payments. You also can use the charts. And guys, we're going to go through homework problems like this. You can use the charts. You'll use 2 different charts. One will be the present value of a single amount. That you'll use just for the face amount of the loan, the bond. You'll use another chart called the present value of an annuity, which is a series of payments. So those interest payments every 6 months, you need to figure out what the present value of all those payments are. So table 2 is going to show you the interest rates of a single amount. Table 4 will show you the interest rate, present value of an annuity, a series of payments. So you take the payment times the factor you get on the table, and you take these 2 figures and total them to figure out the issue price of the bonds. This is important to know, guys. When bonds are issued at a discount, know that the stated interest rate will always, 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 always be less than the market rate. When bonds are issued at face amount, it means that the stated rate will always equal the market rate. And when bonds are issued at a premium, it means that the stated rate will always be greater than the market rate. Guys, this piece is so important. I'm going to give you 2 minutes and write this down while I go get a drink. Okay. Let's see how many of you guys can kind of look at this. If a 10-year bond is issued with a stated rate of 9%, when the market rate is 8%, the bonds will be issued at a premium, a discount, face amount, or cannot be determined. Anyone want to jump in? Tell me. What do you guys think? Should be a discount, right? Or is it a premium? Or is it face amount? Let's see what you guys say. Hopefully you say it's a premium. Awesome. Good. Remember, the stated rate and the market rate are the same. It's face. When the stated rate is less than market rate, it's a discount. When the stated rate is greater than market rate, it will always be a premium. Awesome, guys. Okay. Let's look at this problem. On January 1st, 2018, Waterworld issues 26 million of 7% bonds due in 10 years with interest payable semi-annually on June 30th and December 31st each year. Waterworld intends to use the funds to build the world's largest water avalanche and the tornado, a giant outdoor vortex in which riders spin in progressively smaller and faster circles until they drop through a small tunnel at the bottom. If the market rate is 6%, will the bonds issue at face amount, a discount, or a premium? the first thing you're going to go in is look at that chart. If the market rate is equal to the stated rate, their face amount. The market rate is greater than the stated rate, it's a discount. If the market rate is less than the stated rate, it's a premium. So what we're going to do is we're going to plug this in. Okay, we're going to plug in these figures. So we're going to look at our Excel. And our formulas, financial, I thought it was. Formulas. Oh, I have financial there. Got financial, present value. The rate I thought was 3%. Let me make sure. 3%. Number of periods. I think it said 20. I got to confirm it. Payment 910,000 and 26 million. Right? Do you see the amount that bonds will issue for is 27,934,071 or 072? Do you see that there? If you have Excel on your computer, I want you to take a minute and attempt to calculate this. Okay? Let's give you a minute to do that so you know you've got it. I'm going to give you a couple minutes here, guys. Are there any questions you guys have? Is this making sense? Let's try this one. Water World issues 26 million, 7% bonds due in 10 years with interest payments payable semi-annually. But the market rate is 7%. So the stated rate is 7%. The market rate is 7%. They're going to issue at face amount because the market rate and the stated rate are the same. Okay. Look at this one. The stated rate is 7% and the market rate is 10%. So we go here. The market rate is 10%, 5% twice a year. I think it was 20 periods. 910,000 was the payment. Future value is 26 million. Let me make sure I had that right. 26,910,000. Oh, the market rate is 8. You know what? I showed 10%, but the market rate here shows 8%. So let me fix that. So let me just show this to be 8%, not 10%. I think I did something wrong there. Okay, let's try it again. Financial rate is 8%, 4%, 910, 6 million. So if it's an 8% market rate or 4% twice a year, I'm showing the issue price would be 24,233,258. I screwed up here because I can see here. Do you see I've got it at 8%, but this shows 10%. If the market rate was at 10%, this would be, issue price would be a lot lower. Okay. Now, how do I record these suckers? Easy. Just follow the guidelines. When we show them issued at face amount, it's easy. You issue $100,000 of bonds, paying 7% interest for $100,000, assuming a 7% market rate, will debit our cash and credit our bonds payable. And then our first payment will just be a debit to interest expense and credit to cash. It's easy when they're at face amount. When bonds are issued at a discount, our cash will only be the issue price. Our bonds payable will be the whole 100,000. And we're going to have a difference. The discount on bonds payable will be $67.95. We have to discount them because since the market rate is higher than the stated rate, we've got to come up with a way to pay the interest that they deserve, that they're expecting. So you see in the balance sheet under the liability section, we know we're going to have to end up paying out $100,000. But as of today, the carrying value on those loans is $93,205. We'll make up for the difference throughout the period of the loan or of the bond. Now, here's what we do when we make payments. Remember, the payment amount we give is going to be set. The payment amount is going to be $3,500, period. We're going to calculate the interest expense like we do an installment loan. We take the carrying amount, which is what we issued them for, $93,205, times the market rate, times half of the year, to give us the interest expense. But guys, do you see how that interest expense is higher than the cash amount? That's where the discount comes in. The difference between what our interest expense is and yet what we're giving as cash is going to be offset. The difference is under discount of bonds payable. See, we've got that extra money because we issued them cheaper. So we're going to use that discount to help pay for the interest on those bonds. Now, the carrying amount, when we're issuing bonds at a discount, will increase over time until it hits 100,000. So the second payment is going to be a little higher in interest than the first payment. Why? Because our carrying amount increased. It increased from when we initially issued the bonds. We had the issuance price at $93,205. After the first payment, our carrying value, we add $228 to it because we use that discount on bonds payable to help pay the difference of the interest. So we're increasing our carrying amount. So our interest expense now is the new carrying amount times the market rate times half a year, which is now $37.37. Our cash payment will continually remain the same of $3,500. But the difference between our interest expense and the cash amount will offset against the discount on bonds payable. Every time we make a payment, the interest expense is going to be higher than our cash we pay. So we have to account for it by offsetting it with the discount on the bonds payable. If you look at this amortization schedule, it really helps you understand how it works. You see, we started with $93,205 as the carrying amount. After the first payment, we now increase our carrying value by $228, which is the difference between the interest expense and the cash we paid out. So at the end of the first payment, we have a higher carrying value, and it will continue to increase till we get to 100,000. See how after every period it increases. By the last payment, we have a carrying value on our bonds to 100,000 because that's what we have to pay them. Sometimes students incorrectly record interest expense using the stated rate rather than the market rate. Remember, we're always dealing with the market rate. The only thing we use that stated rate for is the payment amount. The face amount times the stated interest rate times how many periods in a year. That's it, guys. It's the only thing that the stated rate is used to calculate is the payment amount. Okay. When we record bonds at a premium, we're kind of going to do the opposite bit here. So when we issue them, we're going to show a higher amount of cash. We're going to credit our bonds payable for 100,000, but here's the catch. We have now a premium on bonds payable. The difference between the cash we received and the bonds payable. So it's opposite as a discount. Every time we make a payment, we're going to use the difference in the interest expense and the cash we pay out to offset our premium. And our bonds payable will end up becoming the 107,000 by taking away from the premium and adding it to the bonds payable. So the first semi-annual interest payment will show interest expense of 107,439 times the market rate times half a year. But the amount of cash we're giving them, the bondholders, is 3,500 more. So we're going to offset that with the premium on bonds payable of 277. You see how eventually those bonds will come down. Then the next payment, we take our bond payable or our face amount, issue amount minus that premium on bonds payable. It's gone down some, times the market rate times half a year. You see how our interest has reduced from the first payment to the second payment? But our cash stays the same. And we offset it with a premium on bonds payable. When you look at an amortization schedule, it will continue to decrease until at the end, the carrying value becomes the face amount of the bonds. If we record a premium or if we record a discount, ultimately in the end, at maturity, it will all end up being the face amount of the bond. Guys, this is just a crazy way they record bonds. I can't explain it. I really don't work in the banking industry, but it's just how they do it. And so know the components. Know if the most important is the stated rate is just what's sitting on that piece of paper and determines the payment price. But what really matters, guys, is the market rate. That is what really determines what they're worth and what they're going to be issued for. So when the market rate is greater than the stated rate, will always be at a discount. When the market rate is lower than the stated rate, bonds are going to be issued at a premium. But ultimately, guys, when they mature, the face amount will always equal the carrying value at the end. When bonds issue at a face amount, the carrying value and the corresponding interest expense will remain constant over time. When bonds issued at a discount, the carrying value and corresponding interest expense increase over time. And when bonds issue at a premium, the carrying value and corresponding interest expense decrease over time. So in this example, Splash City issues 100,000 of 9% bonds due in 20 years with interest payable semi-annually on June 30th and December 31st each year. Assuming the market interest rate on the issue date is 10%, the bonds will issue at 457,102. So guys, they even tell you what they're going to issue at. Complete the first 3 rows of an amortization schedule. Take your time, guys, and try this. Use a calculator, use your computer to try to see how this plays out. I'm going to just give you a couple minutes here, guys. Hey, okay, sorry about that. I got a phone call. Okay. Any questions before we move on, guys? Any questions? Yes, no. Can you still hear me?
Oh, I can, Professor. I'm not too sure. Why was it the 4.5% times the face amount?
4.5% times this. Can you just tell me what you meant? It
In
is.
the
It's by the carrying, the 4.5% is what was on the stated rate. And that was the face amount times the stated rate is just the payment. The interest expense is the carrying amount times the market rate.
Okay, so because it's semi-annually, do you just like divide the percentages by 2?
Exactly. Because it's only half of that time.
Okay, that makes sense. Thank you.
You bet. Any questions? Okay. Which of the following statements is true for bonds issued at a discount? The stated rate, interest rate is greater than the market rate? The stated interest rate is less than the market rate? So we've done all this. And now let's say the bonds retire. Well, there are various times when bonds are retiring. If they retire at maturity, it's easy. If they retire at maturity, then the bonds payable equal the cash that gets paid. Easy. There's no gain or loss. But if bonds retire before maturity, then we have to show either a gain or a loss. Okay. So this one gives us an example of California Coasters issued bonds of January 1st, 2018 above face amount at $107,439. The carrying value of the bonds 1 year later is $106,877. Record the bond retirement before maturity on December 31st, 2018 at $114,353. So we know we're selling them for $114,353. We need to go to where the current balance on the bond payable and the current balance on the premium on bonds payable is, and determine if there's a gain or a loss. In this case, there's going to be a loss of $7,476, which is the difference between what we're paying minus the difference in the carrying value on the bonds. No gain or loss is recorded on bonds retired at maturity. For bonds retired before maturity, we record a gain or loss on early extinguishment equal to the difference between the price paid to repurchase the bonds and the bonds carrying value. I want you guys to try this one. Okay. Sorry, guys. I work at all these different businesses, you know, as a CPA. And yeah, y'all are seeing me in my robe. Sorry. So someone calls me yelling. Sorry. Hope I didn't freak y'all out. Okay. What do you think of this one? A company retires an $80 million issue before maturity when the carrying value is $48 million, but the market value is $54 million. What's the company going to record? What do y'all think? Anyone?
Wouldn't it be a loss?
Yes. Great, guys. Okay. Okay, guys. So on January 1st, 2018, Splash City issues $500,000 of 9% bond due in 20 years with interest semi-annual on June 30th and December 31st each year. The market interest rate on the issue date is 10% and the bonds issued at 457,102. Using an amortization schedule, show that the bonds have a carrying value of 458,633 on December 31st, 2019. What do y'all think? You see how we start 457,102 is the issue. We always keep the amount of cash paid the same. The interest rate is based on the carrying value times the market rate times half a year. The difference is going to increase the carrying value. Do you see on December 31st, 2019? We have the carrying value of 458,633. Make sense? The way, if the market interest rate drops to 7% on December 31st, 2019, it will cost $601,452 to retire the bonds. Record the retirement of the bonds. So it's telling us what it's going to cost us to retire the bonds, $601,452, which is our cash. We need to show the bonds payable. We need to show the discount on those bonds payable at that time, and then the loss. Does that make sense? Yes, no? Now, as we've done in the past, this chapter also deals with ratios. Look through these ratios. So important for you guys. Debt to equity, we kind of talked about a little earlier. Here's interesting. We all know Pepsi is way bigger than Coca-Cola. Look at the debt to equity of Pepsi and Coke. Now this is interesting though. I thought Pepsi was way bigger than Coke. Sure, it doesn't look like it on here, does it, guys? Look at times interest earned. Just be aware of those different concepts. Okay. So guys, we're really covering it for this chapter. I'm going to end it unless there are any questions you may have, guys. Anything? Well, blessings until next week.